Greetings, friends. My name is Adam Stein, and I am the broker and co-owner of Century 21 Stein Posner here in Boca Raton, sunny South Florida. For those of you that don't know me, otherwise, you know that I am a active participant in the real estate space. I've been in the real estate business now for going on 2 decades, and so I've seen a lot in my time. As the broker and owner of a company, we're very active in the marketplace. We've got a lot of agents out on the street. We've got a lot of customers that we interact with on an ongoing basis. So I wanted to shoot this video because I get a lot of questions, both from agents and consumers, friends, family, people in the marketplace, people going through real estate transactions right now. And I wanted to share with you what I know and give you some information that I also got this week from Dr. Lawrence Yun. He is a chief economist with the National Association of Realtors. Every week, Century 21 brokers come together during this time, and we have a Zoom call. And Dr. Yun was a guest speaker on our call this week, and he was sharing with us the numbers out of the National Association. So I wanted to share that with you as well. From an economist perspective, a very well-respected and incredibly smart man who consults and advises globally, really, on economics. And so, of course, housing is a major component of this country's gross domestic product. Okay, and what's happening with housing has a big effect on GDP. Let's talk for a moment about the word recession and what it really means. And so many of us have maybe some battle scars of the recession of 2008 and 9. That was a hard time for a lot of us, especially those of us in the real estate space. I'm here to say that that's not this, okay, or this is not that time period. There are too many different factors for why that occurred and what were those factors compared to right now. And I'll talk about that in a minute. But a recession is defined, okay, and by the way, I'm not an economist. I'm not here giving you my economic point of view. I'm simply sharing with you information that I have. And likewise, what we're experiencing at a street and ground level for consumers in our marketplace, okay? And hopefully that'll be valuable for anybody watching. And this could be about a 10, 15-minute video because I've got a lot of information to share, but I think it'll be useful and time well spent. I'm gonna try to keep it on the shorter side, but I don't wanna shortchange anybody the information. Got a bunch of notes here that I took. So a recession is 2 consecutive quarters of economic contraction or negative economic growth, right? And so for years now, right, a decade plus, about a decade since our last recession, we've been expanding, okay? And it's just not reasonable that economy would continue to expand, because at some point, values, like for example, in my world, home values outpace income growth, okay? And it just becomes unsustainable. And a lot of different things, but I think real estate. And so we're not in that place like we were in 2008 and 9, but the National Association of Realtors and our chief economist is expecting this year to be a negative growth domestic product year, okay, for the coronavirus, for the reasons of the coronavirus causing to basically shut our, a good majority of our, or a good part of our economy down. I don't want to say a majority, but a good segment of our economy down. And of course, we've got unemployment claims. We're going to talk about that in a minute. And we did see in March, one of the indicators of our business is new pending sales, new pending contracts, homes that go under contract. And in March, we were down pretty steeply. Now, January, February, March, in terms of closings, were fantastic. We had a tremendous run in the beginning of the year. Buyer demand was outstanding. Prices year over year from March 2019 through March 2020 across the United States were up 6-8%. And so there has continued to be this growth in value. But new pending sales were down. Now, we don't have the numbers yet out for April. It's only May 1st after all, and welcome to May. And so we don't have all the numbers, but we do know that new pending sales were down, which makes sense. People were socially distancing, people were going into lockdown, but we are seeing more of an acceptance through April of our situation. And what we saw at the street level was more transactions. We saw buyers coming back out. Now, we're doing it different. We've got masks and gloves, and some are being done by Zoom calls or video calls or what have you. But we are seeing buyer demand increase. In March, we saw the number of showing requests come down. We saw the number of new listings coming on the market come down. But in April, we saw those tick back up, which are great signs for a recovery of sorts, okay? And I'm not making any claims here, and I'm certainly not looking to politicize anything about what the right things to do are. I'm simply sharing with you my perspective and what I learned this week. Hopefully it'll be helpful for you. Just getting back on it. So we've had an inventory shortage for a very long time. And so buyer demand was really outpacing listings on the market, inventory. And so that's why prices continue to go up, just basic economics. We still believe that buyer demand will be very strong. And we did have some sellers that were not coming on the market because of the pandemic, but the sellers that have, their properties are selling. We've been listing property, and if they're priced properly, okay, and marketed properly, and the homes show in a condition that's consistent with their pricing, they're selling. Buyers are out there looking. We've got historically low interest rates, and buyers are taking advantage of that, okay? So we are expecting, and again, I'm not an economist, I'm not speaking to what's absolute, but the National Association's indicating a recession this year, 5% reduction in gross domestic product. Prices have still been rising, and they are expecting third quarter GDP to be more positive, and housing being such a strong part of the economy and inventory still staying low, we're actually expecting strength throughout the end of the year. And the numbers are what they're indicating is about a reduction in transactions, about 10 to 13% per year, this year, excuse me, but about a 1 to 3% increase in values. And so, my agents are talking to buyers, and buyers are saying, I'm going to be on the sidelines because I think values are going to, plummet. And that's not what the National Association of Realtors is seeing. In fact, they're seeing stability. There's going to be a reduction in transactions, but because we have low inventory, all right, and buyer demand is strong, the basic supply-demand economics say prices don't drop. Okay. And so it's important if you're a buyer to consider that. It's important if you're a seller to consider that as you're entering into the marketplace. Okay. We also have unemployment as a major factor, right? We've seen more unemployment claims in this shorter period of time than ever before. But the reality is many of those jobs that were, where people are applying for unemployment are furloughs. They're temporary out of work. Right? Not permanent out of work because the economy is struggling, but temporary out of work because of social distancing. And so the kinds of businesses that come back online are daycare centers, right? Are dental offices, medical offices, right? People need those services, and those jobs and services, they come back online. We did see restaurants actually are not down as much as we're thought to be because people embrace the idea of takeout. I'm going after I shoot this video to pick up takeout for dinner. And so while restaurants are certainly down and certainly affected, not as bad as what was originally thought. And so those are really good factors. The federal government's pumped a bunch of money into the system, right? So we're talking about unemployment claims being up, but in some cases, people are making more money unemployed, getting unemployment than they were in their jobs. The average around the United States for unemployment per week is $1,100 per week, okay? And so that's a good amount of money for people. $4,400 a month, $50,000 plus a year from unemployment. And so that's real money for people. And so what's happening is people are also not out spending. And so while consumer spending is down, people are preserving their capital and getting money from the government, So what happens now with the government having created all this money into the system? What happens is that, we're printing money basically, right? And there's a bond issue. Federal Reserve is buying these bonds. And so the risk there is all this money into the system is inflation, okay, and future inflation. And what the National Association of Realtors is indicating is not inflation this year or next year, but more like 4, 5, 6 years from now. And so what's a way to hedge against inflation is purchase or acquisition of hard assets like gold or real estate. And so today as a buyer, if you're able to capitalize on low interest rates and create a fixed payment environment for the next 30 years, 5, 6 years from now, you're going to be looking at it saying, wow, I'm so glad I bought a house in 2020. And so there's a lot of factors right now that are contributing to, yes, we are likely going to conclude the year having been in a recession. That is what the National Association of Realtors is indicating and Dr. Yoon is indicating. But that does not mean a collapse in home values. In fact, again, as I shared, 1 to 3% this year, and next year we're talking about upwards of 3 to 5%. Okay, there was a reduction this year, expecting around a 13% deduction or down about 13%. But if values are up 1 to 3%, we're seeing only about a reduction of dollars into the system of about 10% dollar volume revenue into the system. But next year, they're expecting with an increase in units sold of 10 to 13% and values increase of 3 to 5% appreciation, you're talking 15 to 20% dollar revenue into the system from the real estate industry in 2021. All right, so the recovery, okay, what's that look like? We need more listings. If you're a seller and you're contemplating selling, now's a great time to be putting your house into the market because you're going to get attention. We're putting listings on the market and they're selling. New housing starts are down, right? So builders are not building at the same rate that they were. And so we had a housing inventory shortage. We continue to have a housing inventory shortage. And so if you're a seller, now's a good time to come on the market and let those buyers capture you at a low interest rate. And by the way, interestingly enough, sellers that come on the market, 70 to 80% of home sellers are also would-be home buyers. And so the mechanism of the system keeps moving, right? And that's the whole point, is we need to keep this mechanistic system moving. We're not expecting foreclosures. Okay, so we had a massive influx of bank-owned property in 2010, 11, 12 as a function of the recession in 2008 and 9. Okay, and that was all a function of a totally different environment. Loans that were not properly underwritten, mortgage-backed securities that were being sold that just weren't good investments. And when that system collapsed, so did all the housing values, okay? Properties that were bought without thorough underwriting, without any cash. If you bought a house in the last 8 to 10 years, you were underwritten properly, right? Your debt to income ratios were checked properly. Your monthly housing expense to income ratio was checked properly. Your asset verification, your employment verification. And prior to the pandemic, we were 2-3% unemployment, which is fantastic, right? And by the way, as it relates to unemployment, think about this. So we're not expecting, what happened in 8 and 9 to precipitously drop and then have kind of this L-shaped recovery where we're just along the bottom for a while. Some are talking about a V-shaped recovery. We're down, but then we're back up. Whether or not that's true, we don't know. But, these jobs where there's an immediate need to come back and go to work is going to put economic activity back into our economy. People are going to get back out into the world. We're going to see the economy start opening up. Some states are opening up today and this week. Georgia was last week. Other states are starting to open up. In my state here, Florida, we're opening up. My counties of Miami-Dade, Broward, and Palm Beach County, which is the major metro area of South Florida, which accounts for 30+% of the overall population. It also accounts for that amount of the coronavirus cases here in our state. So we're still maintaining our stay at home or whatever the quarantine order is for our area. But the state overall is starting to open up a little bit, which is going to put people back to work, going to put money back into the system. Again, this is not a commentary on whether or not that's the right thing to do. I'm simply speaking from what is happening, okay? And we're not seeing buyers or sellers. Buyers are not necessarily overly in a rush. We're not seeing sellers in a panic. It seems to be very stable in that regard. And we're just excited to be part of a recovery. We're excited for the stability that we know that as real estate professionals, we get to participate in to help you, the consumers, make good, smart decisions. And so I hope this information was helpful for you. I tried to condense it here. We're about 14 minutes, so I tried to condense it here into a short enough video that you could take in and get my perspective. Our agents are seeing increased activity. Our agents are putting their listings on the market. Sellers are coming to the market. Buyers are performing. Lenders are closing. And so we're seeing activity. And so if you're in the market, right, if you're a buyer or if you're a renter and you're contemplating buying, well, the downside of renting is that rent inflation will actually happen. Whereas if you lock in a low fixed interest rate mortgage for 30 years, your payments stay static for this time period. If you're a seller, it's a great time to capture the flag because there are fewer listings on the market. And so therefore you're going to have buyers competing. The listings that we're selling, because we're pricing them properly, they're going at or very close to list price. And so it's a good time to be entering into the market. If you're an agent, a real estate agent, and you need some help and support, I mean, our organization has been helping our agents really thrive and succeed at a high level. We're very much engaged and interactive. We're offering upwards of 10 to 15 training sessions a week on how to do business in this environment. And overall, we've always been a training-based organization. Century 21 is the most recognized brand name on the planet. We have a lot of people coming in from outside of the United States overall here in our South Florida market. So if you're an agent and you're not getting the support you need, please reach out to me. If you're my friend or someone that I know, or if you're not and you want to be, reach out to me, because I'm happy to connect with you and share with you my perspective and what I'm seeing and what I'm experiencing at this level. And I appreciate your time. I appreciate you tuning in. I hope this information was helpful for you. Blessings to all. Make it a great weekend.